This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Paper F7, Chapter 24, IAS 18, Revenue. Revenue relates to both income and gains arising in the ordinary course of business. It includes sales, services, interest, royalties, and dividends, but it excludes trade discounts and VAT. Revenue should be measured at fair value of consideration received, and if the consideration is deferred, then the amount receivable should be discounted to present value. If sales are financed by the seller, the difference between apparent sale value and fair value should be recognized as finance income. There's a misprint there. It should be if. The sale of goods recognized when all criteria are met. The criteria are the transfer of significant risks and rewards, but how do you manage to calculate significant? Can you define significant? It really comes down to a matter of professional opinion. The directors may claim significant risks and rewards have been transferred. The auditors may choose to disagree. So it's potentially a case of contention between the client and the auditors. The sale of goods recognized when all criteria are met, so significant transfer of risks and rewards, no continuing managerial involvement, nor effective control of goods sold. Yes, okay. So when we deliver the goods, or when title to the goods has been delivered, and then we're no longer in control and we're no longer involved. Revenue should be capable of reliable measurement, and the probable inflow of economic benefits should result. A reliable measurement of transaction costs should also be apparent. In the context of services, then all criteria need to be satisfied, same criteria as the last four from the previous page, together with the stage of completion being reliably measured. Imagine an audit firm doing an interim audit, and then at the end of the client's year, an invoice will be received. Can this stage of completion be reliably measured? I would have thought so. The same problem arises with construction contracts accounts. How do you measure the stage of completion? Well, in the context of construction contracts, it could very well be an architect or an engineer. It could be by agreement. It could be as agreed that the stage reached is the relationship that the costs to date bear to the total estimated costs. Interest is recognized on a time-apportioned basis, and royalties recognized on an accruals basis. Dividends recognized when rights to the dividend are established. Disclosure for revenue, the accounting policy for recognition, the amount of each significant element of revenue, and the amount of revenue arising from exchange of goods or services.